Okay, welcome to our second currency workshop. You may recall on the last occasion we dealt with the basics of hedging techniques, what spot, forward and option contracts were, and the knock-on effect that foreign exchange movements may have, not just on your sales and your profits, but also on your banking and potentially on your customers' banking. Today we're going to delve a little bit deeper, so it's going to be more trying to customize this, and this is the process we'll do over the next few weeks. So we started with the generic market stuff. We're now going into narrowing it down into how we develop a strategy and a policy, and really from there then the objective will be to bring it to all of you individually, developing policies and strategies for your own particular businesses. So what we're going to do is, if you don't mind, we'll start off with just giving you some big picture stuff again, but it's important. This really is, we're starting with what's called counterparty credit ratings. Now what does that mean? Every bank or every financial institution has a credit rating. That credit rating basically says how safe or unsafe, as it were, that particular institution might be. Now the main reason why it's developed is to monitor what they call credit risk for deposits. Because if you think about it, if you put a deposit with a bank, in effect you're lending money to that bank. And if you lend that money to the bank, you want to get that money back. But how do you assess whether a bank is a good or a bad bet, or how safe it is from a credit perspective? The answer is all banks and most financial institutions have a credit rating. And that credit rating is done by Standard & Poor's, Moody's or Fitch, and they in turn give different ratings or gradings. So the AAA rating, which is at the very top of the slide there, you'll see basically that's as safe a bank as you can get. And you would be somewhat familiar with that phrase, AAA rated. As you go down through the various ratings, you get down to, at the bottom of the orange on the slide here, you can see BBB minus. BBB minus is the lowest, what they call investment grade. Underneath BBB minus, so we're talking BB plus and below, that's known as sub-investment grade, and some would refer to that as a junk status. So in other words, if you have a bank at that category, the sub-investment grade, they're a much higher credit risk. Why is this important from the point of view of what we're doing on the currency front? Well, first of all, there is the fact that if you have cash anyway and you're putting it on deposit with a bank, you should be aware of what the credit rating of that bank is. Because the other thing I should also say is that the lower down the scale that you are as a bank, in other words, the lower your credit rating, the more they should offer in interest rates, because it's a risk-reward trade-off. Banks that have a AAA rating really would pay no interest, you would expect. Banks that have a BBB minus would have to pay some level of interest to attract deposits in the first instance, I should say. But from a currency perspective, you also need to look at this because you have a hedge with a bank. So taking the example that we gave in the previous video, where we were saying, we've got an exposure on the 1st of November, we want to hedge it out to the 1st of December. In that scenario, both the bank and the client, the corporate in your case, have an exposure to each other. The banks always worry about you going bust, because in that scenario, they no longer have a hedge with you, but they've hedged it out into the market themselves, so they're unbalanced. But that equally applies for you. So if we take an example where a lot of companies might be doing their budgets for 2018 at the end of November 2017, and some might decide we have an exchange rate of 87p in our budget, we can actually hedge forward a lot of our sales next year at 87p or thereabouts. So we want to put that hedge in place now. So that means you now are protected against sterling going to 89 or 90p for all of 2018. Now suppose in February 2018 the bank with which you did the deal went bust. Suddenly you would have no hedge. And the disaster scenario there would be that it's February 2018, you thought you had hedged all your sales for 2018 at 87p, the bank goes bust, and now the spot rate in February 2018 is 93p. So not only have you got no hedge, but you're now exposed to sterling at 6p worse. So that's one of the reasons why you would look at counterparty credit ratings as well. And that's just, the next one is just to put it in perspective. This is giving you the long-term credit ratings of Standard & Poor as they apply to the Irish banks, literally just before Lehman's went bust in 2008, and where they are today. So you can see that there was one AAA rated bank at that time, which is Rabobank. Rabobank are now A+, they're 4 notches lower. In the Irish banks, both Bank of Ireland and AIB were A+, and they are now down at BBB and BBB minus. And if you recall from the previous slide, BBB minus is the lowest level of investment grade credit rating that you can get, and so on and so forth. And you can see you've had varying degrees of deterioration, mainly in banks that are operating in the Irish market. And so that probably doesn't come as any surprise. But that again is put up there just to give you an idea of how far from grace, I guess, the banks operating in this market have fallen. I think the other thing to note here is that there's one bank with a AA rating, which is HSBC. And as far as I'm aware, that's the highest credit rating of a commercial bank operating in Europe at the minute. There are some banks that have AAA rated, but they're state banks, German state banks, things like that. And really their credit rating reflects the credit rating of the German government itself, which obviously is AAA rated. So you can see that the quality in general of banks operating in the Irish market, the credit quality, has deteriorated quite a lot over the last number of years. If we move on to documentation, you may recall towards the end of the last session that we did, I referred to documentation. I said it was an administrative burden, but it just needs to be done. Well, there are a number of things that you need to address in this space, and I think it's worthwhile addressing them now. The first thing is you need to have a dealing line in place, and I referenced this at the end of the last session. A dealing line basically means that a bank will allow you to do a certain amount, a quantified amount of forward contracts or options for a quantified period. So typically if you want to hedge your sales for 12 months, you will ask for a dealing line that will allow you to hedge forward for 12 months. And you also then decide how much currency you would want to hedge forward in that 12 months. So in other words, I want to hedge £1 million sterling or 2 million, whatever the figure is. And that's what you do. You say to the bank, I want to be able to hedge, let's say, 2 million sterling for up to 12 months. They then go through the same credit process as if you were applying for a loan. And so they literally have to go for credit approval. And the counterparty then has what they call mark-to-market risk. So if you think of this scenario, a bank really is just a middleman. So if you want to go and sell sterling to them in a forward contract, all they do is they take that and they hedge it out into the market here as well. And they simply take a margin in the middle. So the rate that they quote to you is obviously worse than the rate that they're getting from the bank here. So the concern for them is that if you go bust, they still have a transaction this side, and they have no transaction this side, so they're imbalanced. And that's known as a mark-to-market risk. Now, of course, mark-to-market risk can go both ways. In other words, you could go bust, but they actually could be better off by you going bust because the exchange rate has actually moved in their favour. But they only worry about things going wrong. So they assess this mark-to-market risk when you're applying for your dealing line, and that becomes part of their overall credit assessment. You will have to specify to the currency provider the level of exposure required in the maximum period. We've covered that off already. And then the provider will limit both. In other words, they'll say you can do X amount of currency for Y amount of months. Now, I should also say here, I've been referring to banks all along. There are non-bank providers of currency as well. And some companies will deal with them, and that's fine. That's up to yourselves. The credit ratings issue will arise in some cases there, because maybe some of the non-bank providers, or a lot of them, don't have a credit rating. You've got to decide whether you think that's a risk or not, and B, if you thought it was a risk, maybe what you might do is you either mightn't deal with them, or you might decide you will deal with them, but in smaller amounts or for shorter periods of time. But again, it's just something you need to address. I guess a lot of people are, increasingly we can see a lot of people are using more and more non-bank providers of currency because that market is growing. It seems to be a trend that's continuing. And to be honest with you, their pricing in a lot of cases seems to be quite tight. So, but as I said, we're not going to make recommendations here as to what you do. We're just going to say it's something you need to monitor. The last thing then you do in this space is that when the bank or the provider of the currency says, you know, we will allow you to do so much forward for so many months, they express that dealing line as what they call a risk-adjusted amount. And so, again, I'm just flagging it here in case you see it, because quite often you might want to do, as I said, 2 million sterling for 12 months. That might be in the facility agreement or the loan agreement or the letter that they write to you to confirm this. That might say that's a risk-adjusted amount of 200,000. It's a banking concept. I think what's important for you is if you see that figure, you just need to confirm with them what's the actual amount you can hedge and how far forward can you hedge it, just to translate it into what I call as meaningful information for you. So if we look at the left hand side now of this table, I've dealt with the hedging line already, what that is. A dealing mandate basically is a mandate, an agreement between the bank or the currency provider and you, which says these are the types of transactions you can enter into. Is it forward? Is it spot? Are you allowed to do currencies? Who's allowed to enter into the transactions? Are there limits on it? So you might find, for example, you have a financial controller and you have a financial control accountant below that person. You could have a mandate that says the financial accountant can do spot deals up to 100,000 but can't do forward deals. However, the financial controller can do spot deals up to 1 million and forward contracts up to 1 million. So you can differentiate who can deal and also differentiate the levels at which they can deal. MIFID and EMIR are two other regulatory provisions, and I'm going to deal with both of those in a second. So what I'm basically saying here in this table is whether we look at spot forwards, options, collars or participating forwards, which were the 5 techniques that we looked at in the first session, do they require documentation? And if they do, where are they affected? And this basically is just a synopsis of those things there. So moving on from documentation, as referenced in the previous slide there, MIFID. What is MIFID? MIFID stands for a Market in Financial Instruments Directive. It's an EU directive and it applies to all European countries across the board. It's operational from the MIFID 2, I should say, is operational from the 3rd of January 2018. This has come in a few years ago, but they have now updated it, and this particular one kicks in from January of 2018. The first thing to note is that it does not apply to spot deals. So if you're only doing spot deals, we don't have to worry about MIFID provisions. However, forward contracts may or may not be included in the provisions of it. And I guess what I'm saying here is that you need to check with your own bank or currency provider as to whether the contracts are included or excluded. We can say for certain that options and currency swaps may not be excluded. They must be subject to it. So basically, spot is not subject to it. Options and swaps are definitely covered by it, and forward contracts may or may not be covered by it. So the key thing is to check with your currency provider. And the other thing too is that they are varying between them as to what they require of you in terms of documentation. So unfortunately, I can't be definitive at this point in time because it literally is an evolving process at this point in time, but I can definitely say that it is varying from bank to bank as to what they require. So again, because it's documentation, find out what the issue is, ask them early and get it dealt with. EMIR, I haven't put a slide up now, but basically it's a reporting requirement that was brought in after the financial crisis. Again, for most corporates, first of all, you're exempt from the most onerous provisions, and secondly, because the idea is to report all the exposures centrally, the banks will report them on your behalf, because if you think about it, the bank and the corporate are two parties to the same deal. The banks have to report them, so they've taken on I was going to say they've taken on the obligation. They're not obliged to do it. They've taken on that obligation on your behalf, but again, they will say to you that technically you are supposed to report these things, but they will do it for you. The rules in this area are also changing and actually loosening up a little bit. But again, it's just for completeness sake to mention it to you. But again, if you're not sure, talk to your currency provider about regulations in this space. But by and large, as a rule, I would say to you, is there's probably not a whole lot to do in this space of EMIR. So now if you move on to developing a policy, these are a couple of pointers that we try and sort of set the ground for when we do the one-to-one sessions. Many find it difficult to differentiate between policies and parameters stroke procedures. So a policy to me is a board driven, it's a high level document. The board should approve it. If you have a board that meets regularly at all, this should be tabled as a document approved by the board and minuted as approved by the board. What it does is sets out the big picture then regarding currency, or indeed the wider treasury management of the company. What do I mean by treasury management? I mean your currency, your attitude to borrowing, your attitude to investing if you have cash, basically any of your dealings with banks. And what the policy document does, it sets out what you can and can't do, what you should and shouldn't do, and really sets out the company's attitude to risk management. Then the parameters and procedures document tends to be a little bit more operational. So it talks about the implementation of policy, the management and controls around identifying risk, how you mitigate risk. So I would say it's kind of a drill down, it's more operational really is the best way to describe it. Policy then, if you want to construct it, so how do you actually write a policy? What do you put into it? You start with the policy objective. And we'll cover that in a second. So what's my objective in this area? It's foreign currency management. What am I hoping to achieve? We would then set out who has the roles and responsibilities. So what's my role in terms of currency management? Are there 2 or 3 people involved? what do each of them do? What are their responsibilities? It should set out the details of the risks being managed, because if you think about it, the currency risks only emanate from the fact that you're either buying in a foreign currency or selling in a foreign currency. So you need to detail out those risks in the first instance. What are those risks and how do they lead to you having a currency risk associated with them? It should also set out the permitted hedging instruments, which we've covered already, because, for example, most companies will not use options. I want you to be aware of what they are, and you may choose to use them. But in a lot of companies, I think they'll have a policy that would say we can do spot and we can do forward, but we can't do options. And it will also deal with then authority limits and approval limits. So again, as I've referenced already, you might have different financial accountant who can do a certain level of transactions, a financial controller who can do a higher level of transactions, and then you should also have approval limits around it. So financial accountant stuff may have to be approved by the financial controller. Financial controller should probably have it approved by a director or the CEO or something like that, just to keep it tight. And then controls and reporting will be covered by parameters and procedures document. In other words, what controls do I have around dealings to making sure that people can't deal in big amounts, can't deal in the wrong hedging techniques, and can't enter into transactions for too long a period. And then equally, how do we report on all this stuff? How do we gather the data and capture it? And what I think for most SMEs, what I would do is I would merge the policy and procedures documents into the one document, because they're not that big and your operations, relatively speaking, are straightforward. So I think it's probably okay to merge the two into one for SMEs. The key contents, well, we'd start with the objective, as I said. What would it be? So in currency, I would suggest it's to minimize fluctuations in the profit and loss account by managing the risks that arise from purchases and sales in foreign currencies. And really, that is it. If you think about it, what you're trying to do is you're not trying to make money out of hedging, but you want to make sure that you don't lose money from making these sales and purchases. Okay, you're not, if you're involved in selling and purchasing currency, you'll be trading, and that's gambling, or unless you're a hedge fund or something like that deals in it. So really what we're saying is we're selling into the UK, we know we've got currency risk, and what we want to do is we want to manage that risk that arises from making those sales because we are being paid in euros, being paid in sterling. The next content you might say is what has been hedged, and you'd say that it's either known or highly probable exposures you would hedge. So in other words, I know I'm going to sell X amount each of the next 6 months into the UK, so that's a definite exposure. Or you may say, on average, I sell X amount into the UK every month. It's highly probable. So I'll take a view that that can be hedged, or the bulk of it can be hedged. That again is important, because if you try to hedge transactions that don't arise, you also have effectively a speculative position, because you now have a forward contract maybe in place and you've no underlying sale or purchase. So really you're hedging either cast iron sales or purchases or ones that are highly probable. And the other thing too is that, of course, as we go out the curve, the probability of certainty of sales or purchases decreases over time. But you can equally tailor your hedging accordingly. So if you think that, let's say, we usually do 100,000 a month in sales into the UK, we're very comfortable that the next 3 months we'll definitely do 100,000. And then after that, we think it's 90% probability, 85, 80%. Well, you can hedge 100,000, up to 100,000 over the next 3 months, and then only hedge maybe 80% or 80,000, 70, 60, 50. You can always layer up again. So the point is, your hedging should track your sales, and you can always have it a little bit less if you want to, where you're not sure about the total volumes of sales. Next thing that you'd always specify here is who can undertake the transactions, and I've dealt with this already. Generally, you would limit the number of people who can undertake the transactions. You would also try and segregate here. So in other words, if somebody is undertaking a transaction to do a spot deal or a forward deal with a bank, the confirmations from the bank should never come in to the people doing the deals. Why? Because the potential for fraud is always higher if somebody who does the deals also gets the confirmation into the bank, because they can hide something if something went wrong. So one of the controls that you should always say is these are the people who can undertake the transactions. So the confirmations of those transactions must come in to somebody other than them. But you need to specify who can undertake transactions, what transactions they can undertake, and if there are limits on either the amounts that they can hedge or the period for which they can hedge. You should also look at what financial and non-financial hedging mechanisms can be used. Because remember, you don't necessarily have to hedge risk by just financial techniques or alone. It may be possible to put clauses into a commercial agreement that allows foreign currency movements both ways to be factored into a price at some point in time, or to adjust a price at some point in time. So you can think laterally in this space, and don't just think about it in the context of derivatives or spot and forward transactions alone. And the final thing is that you'd ensure that all banking arrangements are in place to facilitate your policy requirements. In other words, if your policy says we can hedge up to 12 months on our sales into the UK, well then you need to make sure that you've got a dealing line in place from your bank that allows you to hedge up to 12 months. There's no point in having a policy that says hedge up to 12 months and the bank only allow you to hedge 6. So there has to be a correlation between what your policy says and being able to implement that policy in reality. If you move on then to developing a strategy, there's a sequence of events that we would go through, a process, I guess. So in other words, now we've set our policy in place, we've the big picture done of, in general, what our appetite to risk is, who can deal, how far forward we can go, and what sort of flexibility we have within that. So now the next question is, okay, we have sterling sales, what exactly are we going to do each month from now on to implement this strategy? So the first thing you do is you identify the exposures, which is not always obvious, as we shall see in a second. The next thing is then you quantify the exposures. Why? Because if you're going to hedge it, you have to know how much of an exposure you have to actually hedge. What's the size of the financial risk? From there, then you develop the strategy. We know what exposures we have, we know how big they're likely to be, so therefore this is the risk that we now want to hedge. You then implement that strategy, haven't decided what to do, and when you implement the strategy, then you also evaluate it and you go back. It's a circle basically, because if you think about it, as I've said already, your forecasts as you go out the way get less and less probable. So what you do is you hedge, looking forward a number of months. Then at the end of that month, you probably add another month's forecast onto your forecast, but you also will reevaluate the months in between to see whether the volumes are going up and down. And that in turn will tell you whether you need to do more hedging or you're okay as you are, and it becomes a process. So the policy, it's not that you develop a strategy for the year and you leave it at that. You develop it, you implement it, you look at whether it makes sense or not and what the variables are, you evaluate it and you change it if necessary. And that is a continual process. So in terms of identifying the exposures, I suppose the first thing I would say is that you ensure procedures are in place to identify and communicate to finance the transactions with foreign companies. Because remember, most of these transactions won't actually start in finance. They come into finance because it's a currency risk, but they're either sales in foreign currencies, purchases in foreign currencies, or you could be sourcing product, plant and machinery in foreign currencies. So you must have procedures in place that people who are not in finance can identify those risks, identify them early, and have a means of communicating and a method of communicating that to finance on a regular basis. The second thing, and this is often missed by many companies, is you need to identify transactions that may have an initial foreign source but are invoiced in euros. And that can happen either on sales or can happen more likely on procurement. We have seen cases where some Irish companies are selling into the UK and are being invoiced in euros by UK entities. And they would see that as a hedge. And as we'll see later on, that's not necessarily the case. But where this is more likely to be an issue is when you're buying in things. So you're buying in something from abroad, you're invoiced in euros for that. So the view would be, well, if I'm invoiced in euros, I don't have a currency risk. But if the stuff has been made in the Far East, let's say, for example, the chances are it's US dollar denominated risk. And what happens is the people who are setting the prices to you in euros, they look at the dollar exchange rate against the euro and they set a price to you in euros. Now, if you go back and order the same stuff next year, the first thing they're going to do is compare the dollar-euro exchange rate next year versus where it was this year when they were setting the price. And they will alter the price, more than likely, charged into you. And I suppose what I'm saying to you in that scenario is that you've got to be aware of these things, because you can take it that if the dollar moves against those people, they will look for a price increase. However, if the dollar moves in their favour, it's highly unlikely they're going to offer you a price decrease. So you need to tune in to that, because you may find that the exchange rate move impacts on the euro price that you are charged. So try and understand, particularly on the procurement side, the source of the stuff coming in and the currency of that source. I generally use the annual budget process as a kind of a bottom-up foreign exchange identification exercise. In other words, once a year we have a very thorough look at where we're selling in currency and where we're sourcing in currency, and as part of that whole budget process. I've mentioned already that we should ensure the scope is beyond buying and selling, because it could apply to your capital expenditure. You could be buying, it equipment, plant, anything like that abroad in another currency. And they may be invoicing you in euros, but you want to make sure, again, if they're invoicing you in euros, that you're getting, it's been quoted on exchange rate, that is a market rate. One of the key things in this whole space is that identifying these exposures at the earliest possible time. Because the earlier that you identify an exposure, the earlier you can do something about it. So having a process around early identification is very important. And also, who's the source of the information? Because in most cases, if you're selling into the UK, it's the salespeople that know about sales into the UK and changes in the sales to the UK before finance ever will. So who is that source? And make sure that that source has a direct line of communication in with finance who are doing the hedging. And make sure that those processes work, and they work efficiently, and they work regularly. In terms of developing strategy, there are a number of things then you need to think about. First of all, you have to assess the need for certainty versus the appetite for upside. In other words, do you want to just hedge out all your risk as far as you can straight away at the current price, because that's the price, or that's the exchange rate at which you did all your pricing? Or are you willing to look for some upside? Now remember, if you're willing to look for some upside, you've also got to be prepared to take some downside, because you don't know whether the exchange rate is going to go in your favour or go against you once you have an unhedged position. I would use my Treasury policy for guidelines in this space. The Treasury policy should, in some respect, begin to set some level of parameters for developing your strategy. You need to assess the volatility of the currency rate itself. Let me give you an example. I referenced in the last video that we did, in the last session that we did, that euro sterling on average moved about 10% in any one year between January 1st and December 31st. The equivalent for euro dollar would be about 15%. So the dollar has tended to be more volatile than sterling against the euro. And in that scenario, then, one would suggest you need to be a little bit more careful about your dollar exposures than your sterling. If you can, ascertain your competitor position. In other words, do your competitors hedge forward as well, or do they tend to buy spot? Because that may influence, to a certain extent, how you may address some of this stuff. Identify non-financial actions. So, for example, could you invoice in the foreign currency? Could you invoice, or should you invoice, or can you invoice? So, in other words, if you're selling into the UK, are you invoicing in that sterling, or could you invoice in your local currency? You know, what are the rules around the currency of invoicing? Because the non-financial action here could be that you actually invoice maybe in euros rather than in the local currency. And that, as I said, up to a point, that could be a hedge. We'll talk about that in a second. What is the overriding commercial financial objective? Because really, at the end of the day, you're selling whatever you sell into the UK, or you're buying whatever you buy from the UK. You're trying to achieve a margin. You set out to make a sale into the UK. You say, if I sell X amount of it at a price of, it costs us, 10 euros to make it. We want to sell it for 12 euros, and 12 euros at 87p equals whatever it is in sterling. Then you want to make sure that you can sell that sterling at 87p. That secures your margin, and that's how you make profits, and that's how you stay in business. So I would say to you that that must be your overriding commercial or financial objectives, making sure that you achieve your margins on your products and services, or that you don't at least lose it. You need to document your strategy and approve it. Again, what's the view of the shareholders? In most SMEs, the shareholders are more often than not involved in the management of the business. So what's their view on taking on risk in this space? And some may have a bigger appetite for risk than others. But again, that needs to be put into the policy. You need to be very clear about it, and then that can shape the strategy, whether you take a very aggressive or a less aggressive approach to hedging. This next point here is, I'm just saying, is it been invoiced in euros a hedge? So it's going back to the point a couple of points up. If we sell into the UK and they say, look, you don't have to invoice us in the foreign currency, which is sterling. You can invoice us in euros. We'll take on the risk. I'm wondering, though, how strong a hedge that could be. Because what they'll probably do, if you think about it, let's say you're selling to a UK retailer and they say you get invoices in euros, but they're taking in sterling at the tills. So in a scenario where the euro begins to strengthen, it's going to cost them more to buy those euros to pay you. And in a scenario like that, it's inevitable that they look for a price decrease. So what happens is that the euro invoicing actually doesn't really become a hedge. It gives you a delay for a while, for as long as you can resist the price decrease. But eventually, you'll probably have to decrease your price. And on top of that, you'll find it may be very difficult to increase your price should the exchange rate go the other way. In other words, is this actually a downward only ratchet? What's the attitude of your lenders to foreign exchange risk management will be another issue, because we covered that off at the end of the previous session. It may impact on your financials, it may impact on your covenants, but remember, ultimately it impacts on your ability to generate cash and repay loans, particularly repaying of loans. So you may find that your lenders are a lot more concerned in this area than they would have been 12 or 18 months ago, because of the ability of the exchange rate to move in material amounts. How often would you update your strategy, and how often do you evaluate it? Again, there's no point in having a strategy and then just leaving it there. So you develop a strategy, you evaluate it, you update it, you get into a cycle again. But you need to decide on that, and it has to be meaningful. Too often it becomes probably meaningless because people just don't pay attention. But if you do it too frequently, the markets are moving so quickly that it becomes meaningless as well. So making sure that you get that balance right is important. And also, I would suggest a cross-functional review and input. Quite often, it's a very good idea, for example, to rather than just have this as a financial exercise, that you may engage with your procurement and sales people to get their views on it, because ultimately, as I've said, most of these risks emanate from the commercial side in the first instance. If we move on then to implementing and evaluating the strategy, what I would say is, and policies, what you do is you ensure the policy approval for transactions and personnel is undertaking them. So in other words, who's doing the deals, have they got approval, and make sure it reflects that. I would say then you execute all the strategy in line then with approved counterparties. In other words, what banks can I deal with? Because that would be another thing that you would put into your policy. Who are the institutions that I can actually deal with for spot and forward exchange? So making sure that we execute those deals in line with those banks that are approved or parties that are approved, making sure that are only using the techniques or the tools that are approved in our policy. And all those deals then should be documented. And you should document every single transaction, even if it's only on an Excel spreadsheet and you just keep a list of them. But you should keep a list of all the deals, which would detail what was bought, what was sold in terms of currencies, the date the deal was done, if it's a forward contract, the date that it matures, what the exchange rate is, who the dealer was in the bank you're dealing with, and which bank you dealt with. They should all be there, because then the bank in turn should submit a confirmation to you of the deal done, and somebody should match those two, the deal and the confirmation, to make sure that all the details are exactly correct. When you report then all these deals, then you're basically going to have a level of exposures, you're going to have a hedged a certain amount of them, and then you've got remaining exposures, which are unhedged. And those unhedged ones might be because we're not 100% sure that those sales might come in, we're only 50, 60%, so we leave them unhedged. But then at the end of maybe 3 or 4 weeks' time, you should update that again. Those forecasts should become a little bit more certain, and that might prompt you to do a little bit more hedging. But again, it's all about having reporting, measuring the exposures, and updating it regularly, probably every 2 to 4 weeks. You need to monitor this stuff on a regular basis, and also develop a benchmark against which performance can be measured. It's like anything, how do we know we're doing a good job? So a benchmark for a lot of companies might be the budget rate. If they're willing to hedge forward for 12 months at the start of the year, the budget rate is probably most likely to be their benchmark rate, and that's the rate that they want to beat. If you develop that benchmark, it makes sense, and obviously that you report these hedged items against that benchmark. In other words, am I doing a good or a less than good job? You should also then measure the unhedged position against that benchmark on a regular basis. In other words, this is what we haven't hedged to date. If we were to hedge it today, how might that measure against the benchmark? So we can sort of identify how much it costs us or the rate we could get for our sales into the UK at a point in time for the stuff we haven't hedged, and how does that compare against the benchmark again. So, and that's the last 2 points. I would mark to market my hedged and my unhedged positions. So really what you're sort of saying is that at any point in time, we should have an evaluation of the total sales or purchases in the foreign currency that we have in our forecast going out whatever number of months we've agreed. That should underneath it say how much we've actually hedged. That in turn, the difference between those two is the amount that we have unhedged. And we should then evaluate the exchange rate that we've achieved for everything that we've achieved, and also add into that then, if we were to hedge everything at today's rate for the amount that isn't hedged, what sort of an all-in rate could we achieve for the year? And that's really how you're measuring and monitoring and keeping up to speed in this space the whole time. So in summary, at the end of this session now, hopefully what people will have understood is that we've dealt with the techniques in the first session. We've outlined the sort of things that your policy might need to include. And we've also given you the questions that you may ask in developing your strategy to drive on from there. What we will actually do in advance of the one-to-one meetings, which is the next phase, of this, is we'll circulate some draft reports that you may use in advance. So what we're going to try and do is give you some tools that sort of say, right, they're the tools, let's put our own figures into them in advance of the one-to-one meetings, so that if we can populate them in advance, we will now have an actual number of different things we can work with. And what I would also like you to do is maybe just to think about attempting to draft a policy based on the headings and questions we asked. So, don't worry about getting it right or getting it wrong. There's no right or wrong, it's just what's appropriate for you. But just to start drafting it, once you start drafting, you begin to ask questions. And once you begin to ask questions, you get a better quality output, to be honest with you. And if you get your policy drafted, then the strategy falls from that. So as I said, then for the next session, we will take what we've learned from a macro, brought it back down to policies and strategies, and now begin to customise that to each of you individually.